School does not teach you how to pay your taxes, unfortunately, because the curriculum, the system assumes that you are to go out there and become an employee. But what if you don't? What if you build something of your own? You become an entrepreneur, you become a business owner, and you're doing very well for yourself. That's what we're going to be talking about today because employees, they have nothing to worry about because their employer, they just come around, they withhold an amount from their gross wages and they send it directly to the IRS. And all the employee has to worry about is just filing the tax return on time, if not by April 15th, before or by filing by an extension. And not, they don't incur many penalties and interest because again, the employer already withheld an amount from their wages and the IRS has all these employees' money, their tax money. So they have nothing to worry about. But today we're going to be covering how, as a business owner, you should pay your taxes the right way. The safest and the simplest way I know for you to go ahead and pay the IRS is for you to open up an account with them, an online account with them. So you go onto their website, irs.gov, and then all you have to do is attempt to sign in as an individual. And as a very first timer, the system is going to prompt you to create an account with ID.me. Go ahead, and once you do that, it's going to link the account to your identity, to your social security number, and then it's going to pull in everything the IRS has on you. But for purposes of this video, we're going to stick to how you can pay the taxes. So once you go ahead and you create the account with the IRS, scroll down and you're going to see an option that says make a payment. You go click that and then just make sure to click the payment type for estimated tax and then you should be in good shape. From there, it's pretty straightforward and they take any kinds of different payment methods, ACH, credit card, debit card, you name it. They have made it very easy for you to go ahead and give them your money, trust me. So now that we know the where and how to pay the IRS our taxes, now we're gonna go ahead and cover the how much. And it really depends because there's two ways to go about it. One is, hey, you pay the minimum so that you avoid any interest and penalties and then worry about when it's time to file any current, any open balance for you to cover the rest of the taxes, or you want to go ahead and just pay the amount, front loading it so that when it's time to file, you have nothing to worry about it. And then any excess payments that you paid from what you owe, just have that carry over for the next year. If you have no problem with that, that's on another avenue that's available for you. Now, we're going to go ahead and get started with the first option, the minimum, so that you can avoid any interest and penalties. And well, the general rule says that, well, the amount has to be the lesser of 100% of what you paid in taxes last year or 90% of what you think you're going to owe for the current year. And basically, in other words, hey, look, if you are on track to make less money, then pay a little less than what you paid last year. And if you are on track to make more money or the same amount of money, you can choose to just go ahead and pay the same amount that you paid last year and take it from there. Anything in excess that you owe on top of that, you can rest assured there will be no interest and penalties to pay on that amount. Just make sure that once you file your return by April 15th, you pay the remaining balance. Just a quick caveat to the general rule, if you do make $150,000 a year or more, the rule changes for you. It basically goes into, hey, you have to go with the lesser of 110% from what you paid last year or 90% of what you think you're gonna owe this year, the lesser of the two. So just keep that in mind, just a little caveat. Now, what if you wanna go ahead and just pay a certain amount that you're okay with, maybe ending up overpaying at the end of the year and have that amount carry over, the excess amount carry over to next year? Well, I don't know your circumstances, but as a general conservative rule of thumb, I always say, hey, look, put 35% of your profits aside and just remit that over the year in quarterly estimated tax payments, and you should be in good shape. And that applies to, maybe if you make anywhere from 100 or less or 200K, maybe you can, okay, compromise and say, hey, look, I'm gonna do 25%, maybe 30%. But if you're already making anywhere from 250K and above, I would say, hey, at the very minimum, hey, conservatively, do 35%, set it aside, and send that in quarterly estimated tax payments to the IRS. So now we covered the where, the how, and the amount of what you should pay the IRS in taxes the right way. So now we're gonna go over the timing. When are you supposed to give this amount to the IRS? Is it just one payment upfront, front loaded? No, it isn't. The IRS says that you are supposed to pay it in quarterly estimated tax payments. So 4 payments have to be done throughout the year. And the deadlines for each of those payments are, well, the first one is April 15th, the second one is June 15th, the third one is September 15th, and the last one is January 15th of the following year. They're not intuitive, okay? So don't go ahead and assume that it's based on the calendar quarter ends, because it doesn't, right? So just make sure and write those down. And whenever you go ahead and you try and attempt to make these quarterly estimated tax payments, make sure you do it by those due dates. Now, something that some of my clients have asked is, can they go ahead and make these payments every month? And the answer is yes. You can absolutely go ahead and every month make the payments, and there's really no change when looking at it from the top line of what you end up doing by quarterly. Because if you, for example, make a payment in January and then Feb and then March, well, that is the April 15th deadline payments. So the total of those payments make up the first quarterly estimated tax payment. So it really works out that way. So if you want to go ahead and make it every month, totally fine. I actually encourage it. Now, we do things quite different with our clients, because month in and out, we give out a financial statement package to our clients. And then in that package, in the income statement specifically, we in real time, depending on the result of the month, we come up with the tax exposure, the estimated tax allocated to whatever the business profits are for every month, all things considered, because everybody's different. All circumstances differ in a case-by-case basis, and we go ahead and we include it in the financials, and then our clients have visibility month in and out to that number, and then we also layer in what they end up withdrawing off of the business bank account, so that they can see that, hey, look, am I over withdrawing from the business bank account to the point that I'm suffocating myself and setting myself up for failure come next year and I need to pay taxes? Or do I have leeway in withdrawing more money off of the business bank account after taxes, after making an allowance for taxes? Because unfortunately, most small business owners, they fall into the tax cycle trap that I call. I just came up with that from the top of my head. And that is that they create something great, they have a business, and then they make $10, and then they use the $10 for their personal purposes, when they don't realize that they don't own the whole $10, because $2, $3 goes to the IRS. So they don't realize that they really took out a small loan from the IRS. And then come April 15th, and they have to pay the $3 with dollars that they made from the current year that they're in to file. So for example, we are in 2026. Let's say a business owner, did the whole shenanigan that I just described of using the entire $10 for personal purposes throughout 2025. Now, come 2026, come April 15th, they have to use the dollars that they've made in 2026 to pay for taxes of 2025. And then it just becomes a deadly cycle. So just want to be on the lookout for that. Don't be in that spot, very bad spot to be in. And that concludes this video. Hopefully you liked it. Hopefully you found the video insightful. If you did, make sure you smash the like button, subscribe to the channel, follow the channel. If you have any questions, let me know in the comments below. If you have any specific topics that you'd like me to cover, let me know in the comment section, and I'll go ahead and make the wish reality. And with that said, I'll see you on the next one.